Private markets are often described as an exclusive or advanced form of investing, but that description is misleading. It frames them as an upgrade to public markets rather than a fundamentally different system. At a basic level, private markets include investments that are not traded on public exchanges. These include private equity, venture capital, private credit, and real assets like infrastructure or real estate. What matters more than the labels, though, is how these investments function. The structure is completely different from what most people are used to. In public markets, pricing is continuous, liquidity is high, and regulation forces companies to disclose information regularly. Investors can see prices change in real time and exit positions almost instantly. In private markets, almost none of that exists. Capital is raised through private placements rather than public. Offerings and information flows are limited. Valuations happen infrequently, sometimes only once a year. Investors are expected to commit capital for long periods of time, with little to no ability to exit early. This design is intentional, not accidental. Private markets exist to fund companies and assets that either cannot or do not want to operate under the constraints of public markets. For businesses, this means fewer disclosure requirements and more flexibility to focus on long-term goals. Quarterly earnings pressure is replaced by multi-year strategic planning for investors. This structure creates the potential for higher returns at the same time. It introduces risks that are often underestimated or poorly understood. One of the most common misunderstandings is assuming that higher average returns mean better outcomes for most participants. In reality, private market returns are extremely uneven. A small number of successful deals or funds generate the majority of gains. Many others produce mediocre results or fail entirely. Because pricing is opaque and results take years to materialize, it is much harder to distinguish skill from luck. By the time outcomes are clear, decisions can no longer be changed. Another major misunderstanding is liquidity. In public markets, liquidity is so normal that people barely think about it. In private markets, illiquidity is not a side effect. It is the core feature of the system. Your capital is locked up not because something went wrong. It is locked up because that is how private markets are designed to function. Understanding this point alone removes much of the confusion surrounding private markets. They are not secret or elite versions of stocks. They are long-term capital commitments built around patience, uncertainty, and delayed outcomes. The rules are different from the very beginning. When people compare private markets to public investing without accounting for these structural differences, they are usually asking the wrong questions, and asking the wrong questions almost always leads to the wrong expectations. Once you understand how private markets are structured, the next question becomes who actually participates. Access is not limited because private markets are secret, but because the risks require a very specific financial profile. Most private market investments are restricted to accredited or institutional investors. These investors are expected to tolerate long lockup periods, complex terms, and limited information. High minimum investments are common. Fee structures are often layered and difficult to evaluate. Without experience, transparency is also limited by design. Financial updates are infrequent, and valuations are often estimates rather than market prices for large institutions, pensions, and very wealthy individuals. These constraints are manageable. Their portfolios are large enough to absorb illiquidity without disrupting their overall financial plans. For everyday investors, the same constraints can quickly become problems. Capital locked up for years may conflict with real-life needs or changing circumstances. This is why private markets are usually positioned as a complement to public markets. They are rarely intended to replace liquid, transparent investments. Within private markets, different categories serve very different roles. Private equity focuses on acquiring and improving established businesses over long time horizons. Venture capital targets early-stage companies where failure is common. A small number of extreme successes are expected to drive overall returns. Private credit involves lending to companies outside traditional banking channels. It can generate income, but it also introduces credit and default risk. Real assets emphasize physical ownership, such as real estate or infrastructure. These assets may feel stable, but they still involve operational and valuation uncertainty. None of these categories offer guaranteed outcomes. Success depends heavily on timing, manager skill, and broader economic conditions. The biggest risk in private markets is not daily price volatility, it is uncertainty combined with the inability to react once capital is committed. Valuations are delayed, exits depend on future market conditions, and outcomes often become clear only years later. By then, decisions cannot be reversed. This is why understanding private markets is valuable even for people who never invest in them. They explain how capital flows outside public exchanges and why some investors accept illiquidity. Private markets also highlight an important financial truth. Higher potential returns always come with hidden costs for most people. The key takeaway is not whether private markets are good or bad. It is recognizing that they operate on entirely different assumptions. If liquidity, transparency, and flexibility matter in your financial life, public markets will always play a central role. Private markets are built for patience, complexity, and uncertainty. In finance, knowing where you do not belong can be just as important as knowing where you do. Understanding that distinction helps set realistic expectations and avoid costly mistakes.